Let us take up question number 10. Let us first of all read this question. What is given over here? XY Limited is engaged in large retail business in India. It is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operations as that of India. The exchange rate for the currency of the proposed African country is extremely volatile. Rate of inflation is presently 40% a year. Inflation in India is currently 10% a year. Management of XY Limited expects these rates likely to continue for the foreseeable future. Estimated projected cash flows in real terms in India as well as African country for the first 3 years of the project are as follows. So friends, first thing before we read in the question ahead, let me explain that these cash flows are given in real terms. That means these cash flows are not adjusted for inflation. So inflation rate in African country and in India both are given to you. Cash flows that will arise in India and cash flows that will arise in African rands both are given to you. But these are yet to be adjusted for inflation. In simple words, these are real cash flows and not money cash flows. So let us go ahead and read further in the question. XY Limited assumes the year 3 nominal cash flow will continue to be earned each year indefinitely. What will be the meaning of this line? Year 3 nominal cash flow, that means after adjusting all inflation rates, what we get as nominal cash flow or inflation adjusted cash flow, or in simple words money cash flow, that money cash flow of year 3, the company expects that it will continue to be earned indefinitely each year. That means the cash flows will have perpetual existence. That means here indirectly the question is asking you to apply the perpetual growth formula. Okay. Though the cash flows won't grow, that means the growth rate in cash flow will be 0, but these cash flows will be earned at the same constant amount each year indefinitely. It evaluates all investments using nominal cash flows and a nominal discounting rate. The meaning of this line is the company will evaluate all the decisions based on nominal cash flows and obviously the nominal discounting rate. Present exchange rate is African rand 6 to rupee 1. That means 1 rupee equals to 6 rands. You are required to calculate the net present value of the proposed investment considering the following. Number 1, African rand cash flows are converted into rupees and discounted at a risk adjusted rate. All cash flows for these projects will be discounted at a rate of 20% to reflect its high risk. Ignore taxation, and then you have been given 3 years factors at 20% discounting rate. So friends, this was all about the question. Now, how do you proceed to answer this question? Let us first plan the whole solution. For this purpose, let us first look into what is the question asking you to do. The question is suggesting an approach that the company would first convert all the African rand cash flows to Indian rupee cash flows and then apply a nominal discounting rate to bring these cash flows to their present values to take the decision. Now, what is needed? If you want to convert all the future cash flows in African rand to Indian rupee, you would need exchange rate between Indian rupee and African rand, not just for today, but for all the year ends. That is year end 1, 2, 3. For that purpose, you should apply purchasing power parity and determine FFR, that is fair forward rate. The fair forward rate for each year would reflect the expected rate of rupee in terms of rand. Now, look into the ratio. It is 1 rupee equal to 6 rands given. So friends, preferably I will not invert the quote by taking 1 rand equals to rupee 1 by 6. that is going to give me a lot of fractional calculation. Instead, I will stick to the equation that rupee 1 equals to 6 rands. For that, I will consider as if the calculations are made from the viewpoint of African country, and Indian rupee will be treated as good as a foreign currency because the quote is given for Indian rupee. Keep that in your mind. So if I summarize the approach that you have to follow, first step would be to determine the expected exchange rates for year 1, 2 and 3, that is through FFR using purchasing power parity. Second thing, you convert all the real cash flows into inflation adjusted cash flows, what we call as nominal cash flows or money cash flows. Thirdly, convert all the African rand cash flows into Indian rupee cash flows by using the expected exchange rates that you would have worked out earlier. Once you get all the cash flows in terms of Indian rupee cash flows, and that too with inflation adjustment, you will then arrive at a value of perpetuity because year 3 nominal cash flows will continue to exist. Therefore, you will calculate P0 equals to D1 upon KE minus G. You will be determining the value of the entity based on that perpetual growth model, and you will arrive at the value by end of year 3. Once you get all these values, you are going to discount them to their present values using the nominal discounting rate of 20%, which is informed in the question. So now it is all about how to present the solution. I am showing the solution on screen. Please pay attention. So the solution begins with calculation of expected exchange rate for the coming 3 years, which we are calling as FFR, that is fair forward rate. But most importantly, it is to be calculated using purchasing power parity. And now for that, the FFR formula, you know what it is and how to apply it. So we would define the variables, and you just check with one thing. Spot rate is taken as rupee 1 equals to 6 rands. We did this obviously because the quote is given for rupee and we are considering as if rupee is a foreign currency, just for avoiding one thing, that is fractional calculations. As I told you, if you would have taken the other way, 1 rand would have been equal to rupee 1 by 6, and then applying all these calculations will be little difficult in terms of all decimal workings. You may just pause the video and write up if you have yet to finish writing this whole thing, and if you have finished writing this whole thing, let us move ahead and let us now calculate those exchange rates for the 3 years. So I don't have to again explain you anything over here, you know it very well. Just one thing for your reference, spot rate is 6 rands per rupee, and FFR for first year comes to 7.6364. That becomes the spot rate for computing the FFR for second year, and what you get will obviously become the base for calculating the third year's rate, and these are the 3 rates for your reference. Alright friends, if you haven't finished writing it yet, you may pause the video and complete writing it. If you have finished writing already, let us move ahead and we calculate money cash flows, that is MCF, arising in India. So what we have been informed in the question, the cash flows in India which are in real terms, that means the real cash flows have been informed, and through that we have to determine money cash flows or nominal cash flows. So for that purpose, the inflation rate prevailing in India is 10%, and the inflation factor will be 1 plus I raised to n. So in the year column, we would take 0, 1, 2 and 3. The real cash flows are already informed to us, and don't forget these are in thousands. Okay. Now inflation factor 1 plus I raised to n. For 0 year it will be 1, and then 1.1, 1.21, 1.331, and then these real cash flows multiplied by these inflation factors, you would arrive at the money cash flows or nominal cash flows. Once you calculate nominal cash flows, you would notice that all nominal cash flows in India, they are all negative. That means Indian rupee cash flows are just outflows, outflows and outflows from the beginning till end, because your income is going to be generated in the African country and not in India. Alright friends, you may pause the video if you need. If you have already finished writing, let us move ahead. Now what we do is, we calculate the money cash flows that are arising in Africa. So exactly same way, I don't have to tell you anything over here. Only thing is, inflation rate will be 40% over here, and the cash flows will not be in rupees, they will be in African rand. So exactly same way, all the cash flows will first be recorded as the cash flows in real terms, real cash flows, then inflation factors, and inflation factors when multiplied to real cash flows, what you get is nominal cash flows or money cash flows. Alright friends, you may pause the video if you have yet to write. If you are done with it, let us move ahead. And moving ahead, we now calculate the total money cash flow in Indian rupee. So again, all the figures you find in this table will be in thousands. So what we do now is, we will take all 3 years cash flows in rand first of all. Okay, so these are the African rand cash flows which are now money cash flows, and how we got this, we have seen these calculations in the earlier working. Now we want to convert these cash flows into Indian rupee cash flows, for which we have already computed the expected exchange rate in the form of FFR. For the 0 year, it will be the spot rate, correct? Now these are rand cash flows, and these are values of rupee 1 in terms of African rand. So what you are going to do, you are going to take the African rand cash flows divided by FFR to arrive at African cash flows, but then in terms of Indian rupee. So we get these values, and money cash flow in terms of Indian rupee arising in India, we have already worked out earlier. So what we do now is, we identify this column as A, this column as B, and the aggregate of A plus B will give you the total money cash flows. And the total money cash flows what we get will be these figures. Alright friends, you would have finished writing this. If not, you may pause the video and complete the writing work. If you have finished writing, let us move ahead. So now we have one important calculation to be done, that is determining the value of perpetual cash flows at end of 3rd year. As I told you earlier, the 3rd year cash flow as per the question is going to arise every year henceforth indefinitely. Indefinitely means till perpetuity. So we will calculate the lump sum value of these cash flows at end of year 3 by using the approach P0 equals to D1 upon KE minus G, or P3 equals to D4 upon KE minus G. So the nominal cash flow of 3rd year is expected to remain constant indefinitely. Because the cash flow will remain constant, the applicable growth rate over here will be 0. So D4 will be same as D3, that was 16,637. Growth in cash flow is 0 and KE is 20%. So when you calculate P3, what you get is 16,637 divided by 0.2, and what you get is 83,185. Alright friends, let us move ahead. If you haven't written it yet, you may pause the video, copy it, and then move ahead. Calculation of NPV, the last calculation what we have to make, and all these cash flows will be in Indian rupees and it will be in thousands of rupees. So what we have to simply do is just copy all the money cash flows, the final money cash flows, including the year 3 end cash flow in terms of perpetual value and the PV factors at 20%. Total PV will be aggregate of all these present values, and what we get is negative value, that is NPV of investment is coming up as a negative. So write up this calculation, and at the end we are going to conclude that as the NPV of investment is negative, we are not going ahead with this project. So time for you to take note of this, and once you are done with this, it will be end of the solution.